Hey, it's Nicole Harrington, your unicorn realtor. I hope you guys have learned a lot so far and really enjoy my podcast. I really wanted to make it for you so you get a clear vision and understanding on the home buying process. Today we're going to be talking about lending. There's so much to lending that we'll probably have to cut it into two parts because we want to go into details. We want to make it really simple for you, and it's just going to take way too long and way too much information to pick up in one showing. We're going to be talking about different loans, what works for who, because not every loan works for everybody. And the process, there is a huge long process that goes into lending. It's not just one person that sits across you that asks you the questions that's gonna say yes or no, you can get that loan. There's people in the background working, so we're gonna explain that. What kind of deals can different lenders offer you? Not every lender is the same. You can't compare them apple to apple. So we need to take it apart, and we're going to be clear and in detail for you. I keep saying we, and I haven't even introduced my lender yet, who's sitting quietly across from me here. So Cheryl, oh, sorry, I just messed up your name. That's wonderful. Cheryl Cappelli.
It's a tough name.
She goes by Cheryl to me. So, you know, I mess up her last name occasionally. Anyway, Cheryl Cappelli is a lender with Annie Mac, and I have worked for a long time with her. She's awesome. She goes in details. She has patience with every single client she works with, and that's what I love about her. Cheryl, go ahead and introduce yourself.
Hey, thanks, Nicole. I am super excited about doing this podcast with you because, as you know, educating my clients is my passion. It's really what I love to do. So let me just tell you a little bit about myself. So I started in the mortgage business in the back end. I was a processor. So what I was initially was the liaison between the client and the underwriter to make sure we got all the paperwork together to get it in there smoothly. So that means that I have a little bit of a leg up with most loan officers because I spent all of that time learning guidelines and what an underwriter really wants. Now, of course, that's changed over the years and it's gotten a little bit looser at times and more strict at times, and it's going to change all the time. But what that does mean is that I know where to find all the rules. So I have been with Annie Mac Mortgage for just a little under 2 months. They are an emerging company here in Georgia, but they do lend in, I believe, 42 states. So if there are states that you need help in that I am not licensed in, we can definitely help you. But Annie Mac Mortgage's passion is also educating and being more than pushing a button, right? So we all hear about these online lenders that just push a button. And while they do amazing things and they make things very easy for clients, a lot of the things that they do, I can also do to make your life easier, but I have the experience to back it rather than just sitting on the phone for a year or two, maybe not even that long when you reach these folks. So that's where I come from.
You got to make it so much more easy and personal because they can meet you. They know who is on the other side of the phone. And these days, they know who is on the other side of your Zoom call and see them. So I really love that about you, and I think that is a very important part to build that relationship, that friendship, and know that
for sure
people can call you. People can ask you, text you questions, whatever is convenient for them. So let's talk about the different loans. What is out there for people and how can they maybe get it?
Well, so we'll talk a little bit about what's the most common. The most common is what's called a conventional loan. And basically what that means, it's a big word, but all it means is that the loan conforms to the rules that Fannie Mae and Freddie Mac put out about mortgages. So now Fannie May and Freddie Mac. I always get those a little mixed up. And then you throw in Annie Mac in there and I'm all discombobulated, right? But these are two guarantors. They are not part of the federal government. They are private entities that guarantee the loan if something were to happen and somebody defaults, okay? So those are called conventional loans. Those typically require a higher credit score, something over 680. 680 is kind of our tipping point where we decide whether we want to go to the other most common mortgage, which is an FHA, and we'll talk about that in a minute, but 680 is kind of our tipping point. If anything over that, then we want to look at conventional. Typically, the rates are better. So with a conventional, we've got various down payments. A lot of folks think that they must have 20% down, and that's really just not the case. Not with a primary residence. I mean, you will need to put down more money if you're buying a secondary home or an investment property. But if we're just going to talk today about primary residences, then conventional actually has a program that goes down as little as 3%. Wow. Now, there are some parameters around that. There's an income limit, so you can't make too much money in order to take advantage of the Home Ready or Home Possible programs. But for most people, if they're doing a conventional, their low down payment is 5%.
Go into the what's the most income they have? If we work mostly together with first-time home buyers?
Sure.
They're probably gonna more likely qualify for that. So elaborate on that a little more.
Right. So that income limit actually just changed, and so it's a little bit more difficult to get that here in the Atlanta area and in suburbia because they only allow you to go up to about $64,000. And that is including both borrowers. So it's not each. If both borrowers come to me, they in total can only make $64,000.
So if the wife comes to you and she makes, let's say, 50.
Right.
She, even though they're married, the husband is not involved or doesn't want to be on the mortgage, would that work?
Right. Absolutely. So as long as the other person is not on the mortgage, we don't have to count their income. Actually, there's a little known gray area in the guideline that says that even if there are two people on the loan, and this is for Home Ready and Home Possible only, that we don't have to use the husband's loan or the husband's income as long as her income will support all of their debts and the new mortgage, and they can still qualify.
So guys, that was just a small little secret, a lot of weight on there. Did you know that? Did you know that we can split you guys up and make you qualify for those? Well, right. I hope you guys paid attention. I hope you guys understood this and wrote it down for you so you can talk to your lender, talk to Cheryl a little bit more into details if you do have questions. Keep going, Cheryl.
Absolutely.
What else do you have?
Well, if we're going to stay with conventional, let's talk a little bit more about why you would want to go Home Ready or Home Possible rather than an FHA loan. So anytime you put down less than 20%, you do have mortgage insurance, and that's just the facts. The lender wants a little bit more guarantee from an outside guarantor that if something happens to the mortgage, that someone's going to step in and help them. So you do have to have mortgage insurance if you are putting down less than 20%. Where the Home Ready and Home Possible gets exciting is that if you make less than that income limit that they have, they give you a reduced mortgage insurance than they would give everyone else.
How many percentage is a mortgage insurance in general?
Right. So that's a really good question, but that's a lot like asking me what a mortgage rate is today because it really depends on your situation. It will depend on your credit score, your debt to income, your loan to value, all of these things. So they can fluctuate just as much as rates. But what they do is, so typically they use a factor of 35 for the worst case scenario. And what that means is that the mortgage insurance company will come in and guarantee 35% of the loan if something happens. And then, but for the Home Ready and Home Possible, most often, not always, but most often you can get a 25% guarantee. Now, that is not the factor of the actual mortgage insurance. It's just the amount that they're going to guarantee. So that means that the mortgage insurance at 35% is higher than the mortgage insurance at 25%. You still have to go through loan to value, debt to income, and credit score. But that's kind of how it works. Now, if we were to slide into FHA real quick, I don't want to go over a lot of FHA until we get to that point, but FHA, their factor is always the same for everyone, and it's 0.84 of the loan amount. So that's always the same, and it doesn't matter what your credit score is. So,
all right, guys, you got to write this down. 0.8 percent of your loan amount is the FHA, and the conventional varies. So I hope you guys taking good notes here. Cheryl is giving you lots and lots of information.
Doing my best. All right.
What else do you have in your pockets?
So we don't have to use Home Ready or Home Possible. We don't have to do 3%. We can do 5%. We can do 10%. We can do 15%. Again, you're still going to have mortgage insurance, and that is at the full rate when you're doing the regular conventional loan. Again, that varies by your circumstances, but those are also available. So if you saved a little bit of money, we would want to look at what down payment you want to put down and what you feel comfortable with, and how we can make that work inside the conventional area.
How long does your mortgage insurance stay on your mortgage?
Great question, and thank you for that. So with conventional, there is the opportunity, not the guarantee, for mortgage insurance to drop off after 2 years. Now, there are some things that you have to conform to be able to get that or request that to come off. But the biggest one is that you have to have 78% loan to value, or 22%, not 20, 22% equity in your home. And then you would, if you think that's where you are, you would go to the current servicer and you would request that the mortgage insurance be dropped off, and then they would order an appraisal for you.
So now, they don't automatically do that. You got to be on top of it. You can't just let it run in the background.
Absolutely. If that's something that you want to do, you must request from your current servicer. They won't just do it automatically. So you want to make sure that you do that.
Right. Guys, take that down, make a big mark on your calendar. Once you have your loan, go ask for that, because why do you want to pay extra money that you don't have to?
Well, and if you do a mortgage with me, guess what? In 2.5 years, I reach out to you and remind you to do that.
See, that's why you got to go with Cheryl, or at least talk to her. Talk to her.
There's a lot of other mortgage lenders that do that. And I promise you, there are some really great mortgage lenders out there. I'm just one. But when you're out shopping for mortgage lenders, you want to interview them. Are they your mortgage person for life? Are they looking out for your best interests in the future? Not just for this one transaction. Right.
So is there any other lending loans, anything that you think you want to talk about?
Sure, we can flip over to FHA and why it's good. So FHA loans are backed by the Federal Housing Authority. That is a government entity, and they do the guarantee just like Fannie Mae or Freddie Mac does. They typically allow a couple of things that conventionals don't allow. So they allow a much lower credit score. Typically, with most lenders, that credit score is 580. I have seen as low as 500.
Wow.
But I got to tell you, if you're doing a mortgage and you have a 500 credit score, there's going to be some hits. So they're going to make you put down more money. The rate is going to be much, much higher. So if you have time and don't have to move right now, it's better to work with someone on your credit, teach you a few rules to get that credit to 580 or above, so that it's financially better in the future. Okay. So yes, you can, but should you? Not always.
Okay? Gotcha. Depends on the situation of the people and the reason why it is a 500.
Well, not so much just the reason of the 500, but really the timing of your move. Because if you can wait 6 months to a year, financially, over the long term, you're going to come out much better if you can wait, rather than saying, I have to have this house right now. And that program between the 500 and the 580 really kind of works for a certain segment of people. So the last time I did one was a lady who moved from New York, and she sold her very, very expensive home in New York and was able to move down here to Georgia at a much lower price point. So she was able to put down 50%.
Wow.
And so in that case, it worked for her because at putting 50%, the credit score is much better. She's putting down more than they require. And so in that instance, it works, but it doesn't work for everybody. It's available, but it doesn't work for everybody.
Right.
Now, where it gets exciting with FHA is somewhere between that 580 and say 680 score. That's really the kind of range we like to keep our FHA at. Now, of course, there are variances to everything, but that's kind of the typical scenarios between 580 and 680 doing an FHA loan. Now, FHA will allow you to put down as little as 3.5%. You know, what we didn't talk about was another good thing with the FHA that isn't available on conventional is that on FHA, the seller can pay up to 6% of the closing costs for the buyer. So even though they have to put a little bit more down, 0.5% down, because they can't do the home ready or home possible, they have the opportunity to get up to 6% concession from the seller. And that's where you, Nicole, come in, because I know you're a fantastic negotiator, and that's where you would be talking to the seller to negotiate that for your client. Just know that you can do up to 6%. With conventional, you can only do up to 3%. So that's one of the differences. And then again, we talked a little bit about the mortgage insurance. That mortgage insurance is a fixed flat rate for everybody. It's 0.85% or 0.84% of the loan amount averaged over the year, and that's what you pay every month. The other problem, well, not so much a problem.
Did you switch back to conventional with that bit again of the 0.8, or does that also go with the FHA?
No, FHA is 0.84.
Okay.
Yep, FHA is 0.84. It could change when guidelines change. It could change, but it's been 0.84 for a while.
Gotcha. Okay.
Now, the other thing about mortgage insurance with FHA is that it is for the life of the loan. So you have no opportunity. You can't
pay it off after or take it off after 2 years.
Right.
As you can with the conventional.
Correct. Exactly. So, so it would be for the life of the loan. You can't request that it be removed. The only way you can remove it is to refinance out of that FHA loan and go into a conventional loan, or refinance when you have enough equity at 20%. You can just refinance and get rid of it.
Gotcha.
So.
Well, we're going to go into refinancing another time, because that's another big question we have. So we could talk forever on this one, I think.
We absolutely could. I want to share with you real quickly 2 more really great programs. They are very, very specific though, so they're not as suitable to the masses, but I'll give you some highlights real quick. Okay, and I'll just give you some real highlights on these, because they are really great products for those that qualify. So the first one is the VA loan. You do have to be a veteran to qualify for that. They have expanded DTIs, and they actually don't have a credit score limit. So they will write basically any credit score, but there are then lender overlays. But the VA in and of itself doesn't have a credit score limit. So you can have really low and go with them. Really great product for our veterans. You know, they have done an amazing job making sure that we can do everything that we need to do every single day. And we give this ability back to them. Now, they do have to qualify. There are some service requirements. They have to have been in for so long, and that varies between whether they are active duty, inactive duty, or National Guard. So that's too much to really go into here. But if you know anybody who's a veteran, those are available, and they really need to be talking to a very skilled lender who can help walk through this. I hear horror stories all the time where one of my veterans has called one of the big box veteran friendly banks or lenders, and it's the same thing as when you call one of these online lenders. They're people who are just inexperienced. They're not bad people. They're just inexperienced and they don't know what the guidelines are. So they may tell them incorrect information. Then we have USDA, and that's a little bit harder here in Georgia because it does have to be a rural area, but it does not have to be a farm. And that's another one of the 0% down programs. The last one I did was actually a client in Cumming, Georgia, and she lives in a subdivision with a homeowners association. So does not have to be in farmland or very disconnected, okay? And it doesn't have to be over a certain amount of acreage.
How do people find out if their area would qualify that? Do they have to go through a lender, or is there some information that they can look up?
Yep. So typically what I tell them is talk to their real estate agent, and I send the real estate agent the link to the property. But anybody can find this information, and basically you just Google USDA property eligibility and you put in the address of the home that you're interested in, and it will tell you.
Okay.
Now that program also has some income limits, a little bit higher than our Home Ready and Home Possible. The difference is that they have to include all family income, whether they are on the loan or not. So let's just say you have a 15-year-old in your house and he works part-time. I have to include that income too. So that income could actually boost you over the limit. The good news is that the more people that live in the house, the higher the income limit is. So if you've got 5 people, that's higher than 2 people.
Right, exactly. Right. Can you repeat that link again, that they can look that up just slowly so people can write it down?
Absolutely. All you need to do is Google USDA property eligibility, and a separate site will come up. It would be one of the findings on Google, and you just click on it and you just put in the address of the property you might be interested in.
Cool. Perfect.
So I can give you a little bit about kind of the north side, about what might qualify up in there. So a little bit in Cumming, a little bit in Canton, but definitely Cartersville, Rome, and that kind of area. But you can't be inside the city limits of those towns. You have to be outside the city limits. And then that's a 0% program as well.
Perfect, perfect. And guys, I'm going to have a lot of those informations as well below in my descriptions and talking, just my notes, so you can always come back and just read it on there if you can't remember that.
And I'll send you the link.
And
for sure.
You sure will do that, and I'll put it in. So now we have talked about the different loans that we have. Those are the main 4 loans basically that really are working with.
There are a lot more that most lenders have access to. Those are just the 4 main
ones. Right. You want to touch on real quickly on renovation loans. How can people get those? Just very quickly, because the price range first-time home buyers generally look up at are in a range that probably need some kind of renovations, and that scares them away to even look, because they're like, I don't have money to do that. So can they combine, let's say USD conventional loan with a renovation loan, or is that a totally separate one? Just quickly, how can we do those?
And that's super important for the Atlanta area, especially for those first-time home buyers, because you are looking at a price point that is typically snapped up by investors. Yeah. And so you're also looking at homes that are typically just not quite right. These are not great for a tear down and rebuild, or even a ton of renovation. There are some that are good for that. And, if you want more information on that, I can send you more information. Basically, it's just a lot of information. But if we were to put it in a nutshell, yes, you can do renovations. What you will do is you will put an offer in on a house, and during the 10 days of due diligence, or however many you've negotiated, you're going to have a licensed contractor come out and give you a detailed bid. And then with that detailed bid, your real estate agent would make sure that you will have comps in the area. right? Because what we're going to do is when we lend the money is we're going to actually lend on the as is appraised value. Okay. So it won't be the sales price, it'll be as is. So let's say you come in and you put in $50,000 and you do all the kitchen, you do the kitchen and all the bathrooms, right? So we would want to know what the house would be worth if you did that. Okay. So that's how we do that. You do have to have a licensed contractor, can't do it on your own. Which is a big question a lot of people do. They want to know if they can do the work themselves, and unfortunately that's not allowed. And then those are allowed both on conventional and FHA.
And you do that at the same time that loan
Absolutely.
when you do the regular purchase of the home. Cool.
Absolutely.
Well,
so
and
if we're,
go ahead.
I was gonna say, if we're doing a major renovation, which means we've ripped both bathrooms and the kitchen out and you aren't comfortable living there, we can also roll in some of your mortgage payments so you're not paying 2 house payments while you're doing that. So that's really attractive as well.
Got you. That is perfect. Yes.
Mm-hmm.
So, what about so if one of my clients calls you and says, okay, I want to get a loan, what is the process for them to get a lender or a
Sure.
loan, no matter which one? So just kind of
Sure.
go into that.
Right. So I don't just randomly send my application out. I want to make sure that I have a clear picture of what their dreams and goals are before I do an application. So you start with a 15 or 20-minute phone call with me so I can make sure I understand what you want to do, what you and your family want to do, and really what you're comfortable with. Because a lot of times just because you qualify doesn't mean you're comfortable with that mortgage payment. Okay.
Right.
So that's quick 15 to 20-minute phone call with me. I'll send you an application link. You fill that out. That takes about 5 or 10 minutes. I will go through it. I will pull your credit, and then I will do an initial submission to either Fannie Mae or Freddie Mac just to make sure that your loan conforms to those guidelines, because we still have to do all those guidelines. And then I'll send you a list of stuff we need. And so the list could be short, it could be long. It really depends on your situation. Once I have those items in, I will sort them. If we're working within a contract, I'm waiting on the agent to tell me when the due diligence is up and when I can order the appraisal.
Well,
Okay, so we
haven't gotten into that part yet. They're just calling you and they want to get ready for it. What are the basic information that you need from anybody? And then that you need a couple smaller different things from different situations. But there's got to be some kind of basic list that you always need.
Okay. Yep, absolutely. So if you are a W-2 employee, and that's one of the questions I'm going to be asking you, is how you're employed. I'll ask you, are you W-2, 1099, or self-employed? If you're a W-2 employee, we typically need the last 30 days of pay stubs and the last 2 years of W-2s. That's typical. There are exceptions, and there are reduced documentation for some. Okay. But if we were just to talk about what's typical, that's what I would need. Now, if you're a 1099, then that gets a little bit more difficult, and I'm more than likely going to need 2 years of tax returns. And if you're self-employed, strictly self-employed, I'm always going to need 2 years of tax returns. Now, I don't necessarily always have to use them, but I want to look at them, because in my world, if you can paint a clear picture for the underwriter before they get the information, then that reduces the chance of denials.
Gotcha. Now, what if 1099 basically is a self-employed person, and what if they started their own business a year ago? They don't have 2 years to go back. They were full-time employed for a year that they have been 1099. Does that work?
So no, it doesn't. There are provisions for a business that has been in business for 5 years. Then we can look back 1 year instead of 2. If your business has only been in existence for 1 year, then we need you to be in existence for at least 2 years, and we're going to look at both years of tax returns. Now, there are some what I would call non-QM loans that will allow those things, but we haven't talked about those yet. So,
Gotcha. One other step again, another one that we can do. See, Cheryl
yep.
is awesome. She can do a whole bunch of things for you, whatever works best.
Yeah.
So basically, Cheryl needs to know how much money you make, how much money you have saved up.
Correct.
What can you afford for a payment?
Right.
What are your debts? And she will look at all those numbers and put them in a bag, shake them up, and then sees what's going to fall out. And that's the loan you're going to end up getting. Just kidding. She actually goes very thoroughly through those numbers. And that's what part of that I really love on Cheryl and myself. We're both on the same page there. That's because you can afford, let's say, a $300,000 home based on your income and all that. We don't like to push you that far, if in any shape, way, or possible. We'd rather have you be comfortable than home poor, which means you just can't afford anything else. You won't have any money left when your car breaks down. You have no money left if the AC goes out. If you want to take a vacation, because we all need some kind of vacation occasionally.
Right.
Those are all things we think are important for you to have a quality of life.
Absolutely.
Quality of life, having a beautiful home, great family in there, enjoy it, and still be able to do things. And that's where Cheryl and I are very clear about all the time that yes, you can go higher, but we recommend not quite. Now, if you guys say, I absolutely want to, it's your decision. You can do what you want to do. We're giving advice. The final decision is always you guys, okay?
Absolutely. Absolutely.
So,
I think though that having somebody like us on their team gets them to think about questions they might not have thought of. Right.
Exactly. We are asking many, many, many thousand questions. And it's just, we got to get to know you guys really well.
Well, and we're going to spend a lot of time with you, so we need to know each other, right?
That's right. Yeah, we're going to be best friends for a while.
Exactly.
So you need to know, you need to like your agent, you need to like your lender, because you're going to spill out a lot of personal information to them.
Yes.
And those are all private to Cheryl. She won't share those to me.
No.
Unless, you know, you guys say, yeah, it's okay. You two can talk to each other. We're all a team. I'm open to it. But we need that in writing, and I won't touch it. I don't really want to know all of your numbers.
No.
It's just not my part of the job. I stay professionally in my area and put together an awesome team that everybody does their part of their profession, and then we work together. So you guys can stay assured that a great unicorn realtor looks out for you and stays in their lines so they can give you the best information and go get the other part instead of making something up that could or could not be right.
Absolutely. And that, you know, Nicole, that's kind of why I like you. You stay in your lane and you let me do my job and I let you do your job. I mean, we are very distinct and different, and we can help our clients as a team better than alone.
Yes, absolutely right, Cheryl. That is so cool. Well, we had a great conversation today, and hopefully you guys learned a lot. We went over the different loans, FHA, USDA, the VA, and what was the last one? I forgot already.
Conventional. That's the basic one. The basic and most common. Yeah.
Oh boy, oh boy. So we went over those, guys.
Yeah.
We briefly touched on what works for who and why. I think that's also very important, because what can work for your neighbor down the street, and if they're all over it and they're all happy and they think you should do it too, might not be the right one for you. So
that is so true.
Yeah, let's just let Cheryl and you figure that part out. the process of the lending. We talked about that we have a lot of people in the background working. We have a processor, we have an underwriter, and those are people that Cheryl talks to and connects with the information that you gave them, so she can make sure you will get right loan.
Right.
One thing I think we have both forgotten so far, what I need as an agent from you.
Oh, you need a pre-qualification letter.
That's right. So what's the
Absolutely.
difference between a pre-qualification letter and a pre-approval letter?
Right. Well, there's actually 3 steps, believe it or not. So there is a pre-qualification letter, and that is typically an opinion of a loan officer after a phone conversation. And we may or may not have looked at your income, and we may or may not have pulled your credit, but it just means that we've made an opinion. We haven't run it through any of the automated approval engines. We just say, oh, well, based on this information that Mr. and Mrs. Smith gave me, we think that they will be approved for this amount. Now, when I send out that letter, there's a bunch of legalese down at the bottom that basically says that this is my opinion and this is not worth the piece of paper that this is written on. So be very careful when you're getting a pre-qualification letter. Right. Now, pre-approval letter is a little bit more binding. We've likely looked at your
income.
Your income. Yep, couldn't think there for a second. Looked at your income, looked at your credit, probably looked at your bank statements, and we've run you through the automated approval engine. But again, based on this information, we give a pre-approval up to such and such amount, and they're going to put such and such down. And then again, at the bottom, this letter says this has not been underwritten, and the underwriter is the only person that has final approval authority. So this is not written. This is not worth the piece of paper it's written on. If you're working with a great lender, they will go even one step further, and they will actually have your file underwritten before you ever go shopping. So they will actually get in all your information, look at all of your income, look at all of your assets, and they will completely underwrite your income, assets, and credit, and it will be stamped by an underwriter who does only have, they're the only ones that have approval authority as the underwriters. We as loan officers don't have that. So approval authority by an underwriter, and you will get a letter from me that says, you know, Jane underwrote Mr. and Mrs. Smith's file, and based on the parameters and the fact that we looked at their income, we looked at their assets, and we looked at their credit, they will be approved for X amount of dollars at X rate with, you know, X down payment. And that is binding. And the reason that we really like that, and I know that the reason Nicole likes that, is in this environment where, especially for our first-time home buyers, which is who Nicole and I just love to work with, that price point that they're looking in typically has multiple offers. So how do you differentiate yourself? Now, I know Nicole has some secrets that can differentiate you with offers. I know that she's, you know, have her clients write a letter. There's all kinds of things that she can do on that end, but what can you do about the money? Well, you can come to a lender like me that will pre-underwrite the file for you.
Right, exactly. And that is very important for me to have before we even go out looking. Because otherwise you're going to fall in love with the home that you can't afford. And then Cheryl has to break the bad news saying, nope, that's a little bit too much of a stretch. We can't do that. Every other house we're going to look at, you're going to compare to that home. So,
and I really don't like being the bad guy. That's no fun.
You're not. But anyways, so when you call an agent or call me, first thing you always have to do before we go look out, talk to a lender, talk to Cheryl, and get those letters over to me. So we are confident and ready for you to go look at some homes. Right?
Absolutely.
Well, this was really great, Cheryl. I really appreciate your time. We have learned so much information on this, and we're going to base this also on further conversations later on. If anything comes up for me, I know I can always count on you.
Right.
And we can, you know, go into more details as time goes on if people ask for that.
Absolutely. And if you don't mind, can I just give you my email address? It is
Sure, go ahead.
So it's ccapp like Paul, ELLI at Annie, ANNIE hyphen mac.com. That's the best way to get a hold of me. But if you need my further contact information, Nicole has all that for you. And I'll send you my website as well.
Yep, I sure do, and we'll post that underneath and make sure that you guys get access to all of this. So. Cheryl,
thanks, Nicole.
Wonderful. I really always appreciate and have fun talking to you every time you go over it. There's still a tidbit for me. I always, things change so much in life. It's always something.
They do. And lenders and guidelines change all the time. So you want to make sure you're working with somebody who's paying attention to that, for sure.
Exactly.
Yep. So, well, Nicole, thank you for your time. Thanks for having me on your podcast. I really appreciate it. And I look forward to seeing you soon.
Sounds perfect. We'll see you soon.
Okay.
Bye,
Thanks.
Cheryl. Bye, everybody.
Bye, guys.
I'm signing off. And I hope that you took some great notes of today's show. And if you do have any questions, you can get a hold of me. Below on the description is my email on every podcast I put out. So we'll talk soon. Until next time. Bye, guys.